Will we ever see 3% again? Oh, maybe. I don't know. Maybe, probably.
Hey there, welcome back to Finance Zoom channel. Today, we're delving deep into a topic that's on a lot of people's minds. Will low mortgage rates ever return?
No, not by the end of this year.
No.
However, we need to tell you that economists and weather forecasters are the only people that can be wrong most of the time and keep their jobs. So when we predict that, it's just like, who knows? But realistically, it takes it a little while to settle back down if the bond markets settle down and if the Fed quits screwing with it.
According to Dave, the answer is a straightforward no. However, let's keep in mind that predicting financial markets is no easy feat. As Dave often points out, economists and weather forecasters are often the ones who can get things wrong consistently and still keep their jobs. Now, let's break down what Dave's sharing. Realistically, the dust settling in the markets takes some time. It's like waiting for the weather to clear up after a storm. And let's be real, with the Federal Reserve occasionally making moves that influence rates, it can be a bit of a roller coaster. Speaking of roller coasters, think about this. You've got less than 9 months to go, even less by the time you and I are having this conversation. And a lot can happen in that span. So if you're expecting a swift return to those 3% rates, it might be a bit of a stretch. But hold on, don't let those hopes waver just yet. Dave brings up an interesting perspective. While he's not banking on seeing that 3% by the end of this year, he does acknowledge the possibility down the line. It's like a financial adventure we're all on, with twists and turns and a bit of mystery.
In 1978, I got my real estate license. Rates went from 9 3/4 to 10 that September. For the first time ever, we saw double-digit interest rates. They didn't settle back down below 10. They went all the way up to 18 in 1982 under Jimmy Carter. And then they came back down, and in the 80s, I don't remember when they came back down below 10, but it was probably a decade before they came back down below 10. And honestly, I was a young real estate agent at that time, and having lived through it going up, and then it came down from 18 to 14 to 12, even to 11.
Dave takes us back to that time when he was personally witnessing the transformation. Interest rates soared, reaching an unprecedented height of 9 3/4. And then, for the first time, they ventured into the double digits. A staggering 10% became a reality. But let's fast forward a bit. Things got even wilder. Interest rates skyrocketed further, reaching an astounding 18% in 1982, during Jimmy Carter's era. It's a roller coaster ride, right? But as Dave reminds me, what goes up must come down. And indeed, they did. Through the 1980s, the rates gradually descended, but it was a decade-long journey before they dipped below the 10% mark once again. Dave shares his perspective as a young real estate agent living through those tumultuous times of fluctuating rates. As Dave continued to evolve in his career, in 1992, when he stepped onto the radio, he expressed a strong belief that rates below 10% were a distant dream. Yet, history had its own plans. Contrary to his prediction, rates did fall below 10%. It's a testament to how the financial landscape can surprise even the most experienced experts.
Yeah.
2008 crash drove the rates down below 3, and they stayed in the 3 and below 3 until just the other day, until just about a year ago. So the point being that there's a large percentage of the history of single-family homes prospering in the United States that the rate was much higher than 3%, 6%, 9%, even 11 or 12%, and the market moved. The market continued to move.
Now let's zoom ahead to a more recent memory of Dave Ramsey, the 2008 crash. This unprecedented event brought rates crashing down, reaching below 3% and staying there for a considerable period. But as I knew, change is the only constant in this world. Just like about a year ago, those rates began to shift. Dave paints a vivid picture of the financial world as a puzzle, with each piece representing a piece of history. He underlines that throughout significant portions of time, single-family homes prospered despite interest rates being much higher than 3%. 6%, 9%, or even 11 or 12% were common. The market, ever dynamic, kept moving forward. The only distinction, they didn't have a benchmark of 3% to compare it to. You know, there's a fascinating perspective to consider here. The fact that we're even discussing those 3% rates to begin with. It's an intriguing thought, isn't it? Particularly for our millennial counterparts, who are often at the forefront of gearing up for that pivotal step into homeownership. Take a moment to reflect on this. The context we've grown up in has been significantly influenced by the aftermath of the 2008 financial crisis. Wouldn't you agree? We've been navigating through an era characterized by its fluctuations and the ever-present veil of uncertainty.
If you were at 10% 18 months ago and it had come down to 6, 6 would not be depressing. It's not the 6 that's depressing. It's the change from 3.
Yeah.
That's what's depressing. And because you saw what you used to could have had, okay? And that's what throws you off. So if you bought a house at 6, you're not going to die from it. And go ahead and be pissed off and get the stupid thing paid off ASAP. And then, because my interest rate on my home is precisely 0, because I don't borrow money. So there's that. And you can save up and pay cash for a house too. That's a weird idea.
So here's the history lesson we've all been part of. Ready? Hang tight. As Dave was explaining, imagine you were feeling great, like a perfect 10, about 18 months ago. Life was smooth, and everything was going well. But then, things changed suddenly, and you found yourself at a 6. Now, here's the tricky part. It's not just the number 6 that's making you feel down. It's not the number itself that's the issue. That jump from 3 to 6 is throwing you off balance. Why? Because it's like seeing something you could have easily gotten that was almost within your reach. Just like Dave, I've thought about this too. It makes sense, right? It wouldn't bother me if I had bought a house at a 6 rate. Sure, feel a bit annoyed about it, but why not use that energy for something productive, like paying off the mortgage quickly? Speaking of Dave, his home loan has 0 interest. Yes, that's right. He doesn't borrow unnecessarily. Here's an idea that might surprise you. Have you ever thought about saving up to buy a house without a loan? It might sound strange, but it's not as weird as you might think. It's about trying new things and breaking old patterns. So, even though it seems unusual at first, don't ignore the idea of owning a house without a loan. Many people have done it successfully, which could help you achieve financial freedom sooner than expected. Believe me, drawing from Dave's 3 decades of experience in this arena, I've had the privilege of witnessing numerous individuals opt for the cash route when purchasing their homes. Picture this scenario, just as Dave puts it. Reserve $50,000 each year for 5 years. That's a remarkable $250,000 accumulated right there. Now let's pause for a moment. Suddenly, that first home you want doesn't feel so far away, right? I can almost hear some of you thinking, wait, I get what you're saying, but houses in the US usually cost around $300,000. Trust me, I understand your concern. But here's where it gets interesting. Let's look at solutions. I can find smart ways to gather $300,000 or make a good down payment. This way, I can deal with my worries about having a big mortgage. The great thing is realizing that I am closer to my goal than I might think. That first home I want is possible, and the financial journey isn't as scary as it seems. It's about having new ideas and plans to make my dreams come true. And here's the special part. It's about changing how you see things. It's not just about numbers, even though those are important. It's also about your feelings, like frustration or disappointment, and using them to push you forward. Turn those feelings into energy, the power that moves you toward a better future. So, here's the key takeaway. Yes, perception undeniably plays a role, and of course, math has its significance. However, harnessing this situation as a positive catalyst is equally essential, a powerful impetus pushing you forward. I'm grateful you've joined in on this conversation, and remember, your questions and thoughts are always welcome. Together, we're navigating the intricate financial landscape, one insight at a time. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.